Hello, everyone, and welcome to the NASDAQ Dorsey Wright Monday Analyst Discussion for this Monday, November 9th. My name is Saunders, and joining us this week as well is Steve Raymond. And we're coming in this Monday to quite a bit of action going on across the broader equity market. On the backs of this weekend had at least what seems to look like at the current moment a victory for Joe Biden for the U.S. presidential election. Seemed to make up what the majority of the news cycle was going to be looking like at the beginning of this week, until coming in here on Monday morning to see Pfizer, ticker PFE, coming out with some positive vaccine-related news off the back of one of their vaccine tests there, that's leading to further improvement from most of the broader equity picture on this Monday morning. So we'll get into more of that here and what we're looking at from a technical perspective across the broader equity market more in just a sec. But in looking here, we're going to first start things off with looking at a weekly performance review, at least of how the performance looked over the past 7 days heading into this major movement that we're seeing on this Monday morning. So in looking at movement over the past 7 days or so for those major market funds and indexes that we've been continuing to follow over the past several weeks here, saw the last 7 days see a continuation of trends that we've seen throughout the past couple of weeks. Really outperformance from where those market leaders that we've seen over the course of the past several months, really with PDP being the highest performing fund in this performance review, up over 10% over a trailing 7-day basis through market close there last Friday, November 6th. This also saw outperformance from some of those other leaders from a sector perspective, looking at technology and healthcare, communication services being some of those higher performing sectors over the past 7 days, all up over 7%. So seeing pretty broad outperformance from those leaders up until movement this morning, and underperformance from some of those laggard areas over the course of the past 7 days, with utilities and energy being down towards the bottom end of this performance breakdown through movement on Friday. But coming in here this morning on Monday, seeing quite a bit different picture. The improvement we've seen from on the backs of some of this vaccine and election-related news has led to some pretty significant outperformance from some of those more laggard areas. We see small caps picking up the pace pretty significantly with the Russell 2000 up over 5.7%, at least at the time of this recording there, and a little bit of underperformance from the tech-heavy NASDAQ composite that we've seen. Still certainly positive, up just shy of 1% on the day. But certainly not as much outperformance as we've seen from that area over the past few weeks. Looking at it from more of the sector perspective with intraday movement today, we're seeing, again, information technology still posting gains, and actually all of those broad S&P 500 sectors posting intraday improvement. But those areas that have continued to kind of lead the way, technology, consumer discretionary, not showing quite as much improvement there. Technology still up about 2%, consumer discretionary up about 0.75% there, and significant outperformance coming from those laggard areas of energy, up over 15% at the time of this recording this afternoon. Financials as well, up almost 10%, at an intraday return of about 9.5% there at the time of this recording. So, Steve, definitely seeing some interesting movement on the backs of some of this this news that we've had over the past day or two here.
Yeah, we sure have, and keep in mind, this sets us up, as we all know, into the seasonally strong first quartile. As we finish up this year, it's really the beginning of the seasonally strong cycle, and so, as we often experience, we like to be in the leaders. Leadership can remain the same. Leadership can change, but the whole goal is to stay with the leaders. And as leadership, takes over other leaderships, we're generally already there. So again, this makes for, I think, good news as we're coming into the end of 2020, a very emotional year, among other adjectives we could say. And we're on the right pace. Where the point is that equity is in charge, and now it's about dicing up, possibly on this call, some of the areas that you as the advisor should pay attention to. Back to you, Ian.
Absolutely. There's Steve. And one of those areas that we've been continuing to kind of monitor or pay attention to, at least on these updates, has been the 20-point chart of the S&P 500. And then looking at movement this morning, as we touched on at the onset of this video, Saw the S&P 500 reach a new all-time high with the gains that we saw this morning. That 20-point chart climbing to an intraday level there of 3640 before backing off a little bit this afternoon, but still seeing the broader S&P 500 surpass that all-time high on the chart, which previously came in at 3580, moving significantly higher, still up over 3% at the time of recording too, and prior to that climbing to that high of 3640. Seeing that kind of continuation of improvement that we saw from the broader market over the past week or two, moving up from those lows that we got to there in October at 3240 and climbing straight higher in a column of X's from that 3240 point up to that 3640. In terms of looking at some support levels, if you're looking at the default chart, you see some support around the 3,500 to 3,490 threshold that you see highlighted in red over there on the right-hand side. Also see some support coming in at the 3,440 to 3,420 area on that default chart. And then in looking down at the support offered on the 20-point chart, we see some support offered down at the 3,240 and 3,220 moving down from there. So definitely some support levels that are offered there, and seeing the market continue to rise is at least always a good sign in the case of the S&P 500. So we've seen that improvement over the past week or so lead to some significant indicator changes as well, with that continued participation upward shown by many of these names, leading to a reversal up into a column of X's on the bullish stock exchange, ticker BPNYSE. So for those of you who may not be as familiar, the BPNYSE indicator measures the percentage of stocks in the New York Stock Exchange that are trading on a current point and figure buy signal. And after market movement last Thursday, November 5th, we saw the indicator reverse back up into a column of X's from a chart level of 46% to a chart level of 52%. There would have seen that chart change occur after the market close on Thursday, so on Friday. Coming in here today with the continued improvement we see from most areas across the domestic equity market, we're looking at an intraday bullish percent reading for the BPNYSE all the way up at 64%. So quite a significant pop after that reversal we got at the end of last week, and speaks to the basket of securities that we're looking at for the New York Stock Exchange there. As you may know, the NYSE has more inclusion from the small cap or value focused areas across the market. And so we saw it take a little longer to reverse up into X's versus some of the other more focused, large cap focused bullish percent indicators that had reversed up earlier. But after that reversal we got last week, the continued outperformance we see from those small cap and kind of value oriented areas through intraday information here this Monday, leading to that significant pop on an intraday reading for that bullish percent up to that chart level of 64%, at least at the time of this recording this afternoon. And we see some of that small cap strength depicted also as well in looking at the Russell 2000, looking at the iShares Russell 2000 ETF, ticker IWM, rose significantly this morning as well on the backs of that outperformance from kind of the more laggard area to mark a new all-time high, surpassing its August 2018 high, which came in at 172, to reach a high this morning all the way up at 178. So pretty significant rise from that particular name there, giving it second consecutive buy signal at 176 and continuing to ascend up to that new all-time high at 178 this morning. And looking at it from a support perspective, we had some support that's offered there on the default chart at 152, and then at 144 could get at some closer term support if you look at a more focused 1 point per box size chart. But Steve, as well, we've seen some strength from a score perspective. I mean, the IWM with the score of 3.12 is certainly not as favorable as some other areas across the domestic equity market. But that score direction there of 2.49 is pretty significant, and we see that has remained kind of consistent in a lot of these small cap focused areas over the past few weeks here.
Yeah, it certainly does. And Ian, if you don't mind, if we could go back one slide, I want to start with a comment on the market chart, and then we'll move back to the small cap chart. As many of you know, that the S&P 500 from a sticks point of view, from a line chart point of view, not necessarily a point and figure point of view, has been making a triangle pattern since September up until last week, which was a series of possibly lower tops and higher bottoms, leading this triangle pattern at the election. As Ian, as you pointed out, we broke into the upside right out of that triangle, right off that line that we stopped at on Friday. And that tends to be a pretty good pattern there to suggest, further upside from here, not necessarily that this is the end of the road. And I just wanted to mention, possibly even from an abstract point of view, that if you go back a year, you go back not into 2020, but you go back into 2019 and 2018 and 2017, the primary core market, meaning the S&P 500 collection of stocks, was riding in a trend of its own. If you extrapolate that trend where the prices actually traded, not above the prices, not below, but on the line, and you extend that forward, kind of on a incremental time basis, where that price would have been, you could say, under smooth market conditions by January 1st, 2021, would be, in an area of and I'm going to, give you a number here, 4,350. So the idea is the market, probably would have been at a higher level than where we are here, not getting into what we call the huge 2020 dilemma, COVID being among the reasons for that. And so really some of the trending components or some of the upside, if you will, targets are higher than where we are here. So keep in mind that as some say, we might sell some things and we might reposition some things. And, the idea here with the breakout on the election out of the triangle and taking a look northward at where the trend of the market would have been, not running into some massive 2020 trouble, those price targets are still well above where we are. I make these comments to say that, that as some, have looked at the seasonal quarter coming in and thought, well, I'll wait and see if more is going to happen. Well, more just did happen. And the other idea is that I don't think the market's too overbought or the prices are too high compared to where it would have been or could have been. So the idea here is to maintain the offense that we have already been on and stick with that offensive game plan, to take advantage of where this may lead to, which in general could, and you could say should be at higher price levels by the time we end the year. So Ian, if we could go back to the small cap chart, move forward one slide, to reiterate that this small cap revolution, has been underway for some period of time. I'll make a couple points. The small growth has been, certainly more of a newer comer over the several months, but mid growth has certainly been a leader, for many months. Some of the models, FSM models that just updated that many of you follow out there, you can see for yourselves have already been in a mid growth, already riding a mid growth, and several of those models, as we came into the FSM update for November, actually kicked out the NASDAQ Qs type, and ultra large cap growth 100 funds. Several models did that, and then replaced it with a very precise small cap growth counterpart. So some of that action gets us to today where we can see, wow, and the small caps are really following through. And many of the relative strength calculations, already pointed the compass that way in the first place. So, with that said, I think things are, going along with the plan that I may have mentioned some moments ago, is that the market can change some relative strength preferences. Here's an example where this may indeed be what's going on here. And the relative strength method, meaning the pragmatic method of saying, where is the relative strength? Where are the models? As an advisor, you're saying to yourself, what did I see? What did I do about it? Leads you to the same answer. You're here. We're at the same conclusion, is that your small caps are now part of the big plan, as they've been flagging us down that, the scores are improving. So, Ian, if we can move on to the next slide, the big idea here is the small caps have risen to some sort of leadership in the natural score on the Dorsey Wright system. But what you're seeing here is actually a view by score direction. Score direction is an incremental short-term improvement algorithm, which demonstrates, who's moving in our current time frame. And I don't mean current time frame as of yesterday to today. I mean the current time frame over the last many months. And some of the best score directions we see on the entire system concerning the style boxes is all about small cap, actually, from all the way from the hyper micro cap, to the small core, to the small growth. And Ian, I'm going to hand it back over to you on more on styles after I make an honorable mention to small value. Small value has an excellent score direction of 2.13 points. And one might say, well, I've seen score directions in general on different asset classes that big before. But I will remind you, we haven't seen a small cap value score direction of over 2 points in this footprint since 2009, coming out of 2008. So this really puts you back at kind of a major improvement cycle in the small caps. And I just wanted to make sure small value didn't get left behind, because just over the current 10-day roll, not only does it have the most significant score direction, that group has had to itself in some, I'd like to say, 10 years, but the score itself just crossed above the 3-score line, in the same event horizon, which is right now. So again, there's a lot of stories to tell, about relative strength, and there's a lot of stories to say, hey, small caps are now an integral part of that. Back to you, Ian.
Yeah, absolutely, Steve. And I mean, in looking at it from the size and style perspective there with these scores, I mean, it is important too, like you said, we still see from a straight score perspective, again, we're looking at the directional rank, but still those average scores are depicted. I mean, we still have the mid cap and large cap growth kind of outpacing the small cap areas, but just seeing that significant improvement from small cap over the past, from that low over the past 6 months. And I mean, from the value perspective too, I mean, this near-term strength in value that we've seen from that directional standpoint, I mean, is consistent with what we've seen from a performance standpoint going back to the broader market. I mean, looking at the Russell 2000 value index there, I mean, it's up over 9% on an intraday basis at the time of this recording on Monday, versus the Russell 2000 growth, which is still certainly very positive, up 3.4%, but not nearly as much so as that value-oriented counterpart. Now, in looking at it from a year-to-date perspective, we still have, even with the improvement today, that Russell 2000 value index is still down about 9% on the year, whereas the Russell 2000 growth is up about 17%. So, I mean, in looking at it from taking today's movement and looking at it from that broader perspective, I mean, continue to see the outperformance from those laggard areas seeing the outperformance from those laggard areas is definitely notable and may affect the score somewhat. But I mean, that strength in growth, at least for the time being, is still something that we see consistent on these size and style rankings, as well as the broader all group ranking of that asset class group scores page, Steve.
Yes, and let me make a comment, Ian, that if we move back to the slide we were just on for just one moment, we've made some comments possibly over the last 5 months. I know I've tried to take a stab at making the comment a couple times, and others have too, which is, there is a relationship between large growth and small value. I call it diagonal, meaning you generally don't see large growth and small value, lead the market in the same era at the same time. It's usually one or the other that is the ultimate leader. One's improving and in leadership, while one's taking a break. This could be what we're seeing here. One day does not an era make, but it's something that we've pointed out before, is that we're waiting for small value and large growth to find their diagonal position and then isolate on that. And so that's certainly a subject to stay on top of. Is the small value move into market leadership for real, and then and that's what we do. Right. We stay on top of the subject, keep making the measurements, go with the models, The models are on the growth side of the small cap paradigm at the moment, but the small value could indeed, take a bigger segment. And some may say, well, if I wait for all those things to transpire for small value, Steve, we've missed it. And I think as history teaches us, that's not actually true. Once small value, to get into a very high dominant position can run for a very long time in a high dominant position, and that's where all the money's made. So I think that obviously we're interested in small value, but we're really interested in the small growth. We're watching small value, but we're still sticking with the growth paradigm of the market as the overweight. But we're looking at the issues just like you as the advisor are measuring the issues, and and there could be a major change on that come up in front of the headlights here. But that's what it's all about. You got to make your bets, you got to look at the evidence, and then you got to go forward. Back to you, Ian, on the all groups page.
Yeah, and I mean, in looking at that, like you said, you still have that kind of growth focus from that looking at the average score perspective. So, I mean, in looking at the all groups with the asset class group scores page, we have over 135 different areas that we're ranking by that average score. And in looking here at the top 20, we still see, through market movement again on Friday, so not taking into account the intraday movement we've seen here on Monday. That kind of growth dominant theme at the top end of the rankings. Internet and technology being ranked 1 and 2, mid and large growth 3 and 4. And seeing that continued kind of strength from a broader perspective in equities, and that S&P 500 index funds group continuing to maintain that high core percentile ranking above 90%. On the flip side, at the bottom end of the rankings, we still have money market scoring in relatively low territory down at that score ranking of 6% there, Steve.
Yeah, that's very true. The core is doing well. As I've mentioned before, I don't like to see the core get too high in a rank position because, we want to assume that the market's broadening and healthy, and a lot of groups are participating. That's exactly what we have here. So the good news is the core is not too high. A good news is that, the money market's not too low. But I think at this moment, or in this pocket of time, it's been, irrelevant to say, hey, cash is very important to hold. I think the relevant thing is, the world is offering 95% of its own asset classes that are functioning very well. And it's up to, the advisor, it's up to, us, you and Ian, me and you, and just every person saying, hey, of the 95% of the asset classes around the world, which would serve my client's allocation best. And we could come up with different answers for that question. But I think all of our answers will probably be not money market. Let me mention a group that we haven't mentioned yet, which is, something analogous to global and international growth. Global and international growth type of funds, which, you could think of as emerging markets and growth and international growth and in some sense global, which is part U.S., part non-U.S. These types of things have been creeping in our models over the past months, and they've carried forward in the recent FSM update in November, where you've got some models there where people were looking at each other saying, hey, there's a lot more international in these models than there used to be. American funds kind of let it off with small world, new perspective leaking in there some months ago, and it's followed through to other fabulous funds from T. Rowe Price and all things like that, which are exemplars of how international rotates into a great strategy. But back to the case in point, the international, the global and international growth group ranks at a number 11 here, the 11th spot in the all asset class group scores view, and that's a pretty good ranking. And I'll tell you why that's good ranking. We haven't seen a score at this level since prior to 2008. You just reached a level, and you reached it over the last rolling week or two, where we haven't seen that group score at that level since going into the 2008 paradigm. Back in the old days when non-U.S. was extremely, everyone would say, a leader. And I think you're back at that score level right here, being at the, certainly above 4, but, getting close to the 5 score level, where groups like this have been known to trade. Just they haven't been known to trade there in this present era, but now they're back. And so I think amongst all the wonderful news to talk about, which would be, U.S. and then U.S. small caps and the growth paradigm and the up and coming value paradigm, all this excitement, I wouldn't want anyone to forget that there's plenty of excitement non-U.S. as well. And that's good news for the allocation process, because it allows the advisor to think, hey, I can get into the U.S., I can do things there, I can go non-U.S. and broaden out and diversify the allocation by doing many things there. And that's what the FSM models as a type of model are doing as we speak. And then many advisors, as you follow those models, would do the same. Or if you don't follow the models, you're still seeing the same data. So I think you've got some great things happening non-U.S. as well as U.S. And that really makes for a great story to go back to the client and say, hey, look, we're in a new quarter. We're in a seasonally strong quarter of the years. We're starting off the game plan. Here's the new allocation. We're heading for the end of the year. As we head for the end of the year, we're heading for 2021, and we've got a whole new paradigm there. So I think it's a great day, a great week to go back and say, as you touch base with your clients, you got to ask yourself, are you touching base with your clients? And if you haven't yet, this is a great time to say, look, there's a lot of things going on. Let me show you this. Let me show you that. And put a game plan together to make sure that we're in good shape as we head to the target, which is right now the end of the year, to close out the 2020 and then move on from there. So these are important data points. These are important themes, Ian, I think that we talked about today. We could talk about a heck of a lot more, but I think that, keeping it simple and saying, hey, we've got some good ideas and some broad things to help steer what the allocation may need to look like. And here's some great ideas to monitor. And here's a great story to go back out and tell the client, here's how we're addressing, the market and have that confidence that you're relevant, that there's a relevance in your message, of how important these times are. Back to you, Ian.
Perfect. Absolutely there, Steve. I mean, continuing to see the leadership intact, at least through market close there on Friday, and continuing to monitor for those some potential changes as we move through what's at least is shaping up to be certainly an eventful wrap up to what has been quite an eventful 2020 here. For those of you who are looking for any kind of questions or anything we have specifically pertaining either to this webinar in particular or in general, you can absolutely reach out to us there. The contact information provided there at the bottom of the screen. You can call us at 804-320-8511, or more than welcome as well to shoot us an email at dwa@dorseyright.com. Of course, with all the movement we have going on throughout the market at the beginning of this week, we'll continue to try to keep you up to date through the written research, and that's available there at dorseyright.com after you log in. For anyone who is not a subscriber to our platform but would like to access some of this research to stay up to date with what's going on in the market, you can take a free trial of the platform there at dorseyright.com/trial. So with that, Steve, I think that wraps up most of what we were looking to cover here this afternoon. Was there anything else you wanted to offer as a parting gesture?
Well, it goes back to what you just said, Ian, which is, now that it appears that, there's some hope and some things happening. Sometimes, we as advisors or possibly advisors out there say, we've made it through. Now we can take our eyes off the ball because everything's fine. I think the parting comment would be, is even if everything's fine, which I think most of this call suggested that things were going well, this relative strength potential change that goes on is extremely important to stay on top of. This is no time to take your eyes off your work, but to follow through with that. Catching any new relative strength trends, if they occur, is extremely important, and staying with old relative strength trends that are no longer in force could be very harmful, to your long-term game plan while you're in the short term. So I think that, the parting comment would be, keep your eyes on the ball starting tomorrow, finish up the week. call the clients and give them the game plan to get them to the end of the year. So this is the time to do the work and stay quite on the ball, nose on the ball, the coaches used to say, and that's what we got to do. So I appreciate the time, Ian. Thank you for the opportunity.
Perfect. Well, absolutely. And thank everyone very much for joining us here this week, and we look forward to having you back next week.